And again, good afternoon. Thank you for being here. This webinar is being recorded. I'm Bill Maurer. I'm the Dean of the School of Social Sciences, and I'd like to welcome you all to our Spring Economic Forum. We've been doing these since the pandemic. We've done a mixture of formats, some wholly in person, some hybrid, this one completely on Zoom. And I'm very pleased that you could join us this afternoon, and I'm especially grateful for our moderator and our invited panelists today. We will be talking about the recession that never happened and what's next. So a little bit looking to the past, where we are now, maybe some prognostication. Our speakers will be Professor Eric Swanson from the Department of Economics here at UC Irvine. Professor Swanson studies unconventional monetary policy, particularly forward guidance and large-scale asset purchases by the Fed, and the relationship between financial markets and the macroeconomy. He got his PhD in economics at Stanford and served as a senior economist with the Federal Reserve Board and senior research advisor with the Fed in San Francisco. In addition to being an economics professor here at UCI, he's also a research associate with the National Bureau of Economic Research. We also have with us Professor Bill Branch. Bill Branch is chair and dean's professor of economics at UC Irvine. He's also a research affiliate of CECIFO and the International Network on Expectational Coordination. He serves on editorial boards of several journals that specialize in macroeconomics research, got his PhD at the University of Oregon. His research focuses on the role played by private sector expectations and forecasting in macroeconomic models applied to a number of issues in monetary policy, monetary theory, asset pricing, stock market bubbles and crashes, and so on. And then we are also joined by Jessica Monge Coria, who is currently Senior Outreach Manager on the Community Development Team at the Federal Reserve Bank of San Francisco. Prior to joining the San Francisco Fed, she worked in affordable housing and early care and education, focusing on project management, grant making, and partnership development. Jessica works out of the Los Angeles branch of the San Francisco Fed and is passionate about building healthy, inclusive, and sustainable economies here in Southern California. And moderating the discussion is Peter Trepp, who has been our moderator for these economic forums since we started them a few years ago. Peter is the founder, chairman, and CEO of InnoPath Therapeutics, a biotech company focused on oncology drug development. He's a luminary biotech and software entrepreneur with $1 billion in exits throughout his career. Before founding InnoPath, Peter served as the CEO of Face First, a globally recognized market leader in facial recognition technology. He's also the author of a book, The New Rules of Consumer Privacy, that discusses how consumer-facing organizations can balance their customers' needs for privacy, security, and convenience. He earned his bachelor's degree in economics here at UC Irvine and his MBA from the UCLA Anderson School. He currently serves as ex officio trustee on the UC Irvine Foundation and is chairman of the board of counselors for the UC Irvine School of Social Sciences. Now I'm going to hand it off to Peter in a second, but in the meantime, if you have questions that you'd like to pose to the panelists, please use the Q&A feature on Zoom. I will be fielding and moderating those questions after we hear from the panel. So again, welcome, and Peter, I'm going to hand it off to you.
Thank you very much, Dean Maurer. Good afternoon, and welcome everybody to our Spring Economic Forum. I'm delighted you all could be here. If you've been following the news, last year, as you probably know, many economists were predicting a recession, one that never came to fruition. And going back decades, we're used to seeing downturns occur in highly predictable cycles, and they're usually triggered by some material economic event, subprime mortgages or the dot-com bubble more recently, and we haven't seen a big trigger this time around. So what happened, and when might we expect a downturn? We're going to get into that today and invite our panelists to provide some remarks. And at the end, as Dean Maurer said, we'll be looking to our audience to ask some questions before we wrap up. So let's start off with some opening remarks. Professor Swanson, would you like to start things off for us?
Sure, I'll be happy to, Peter. Let me share my screen. That looks good. And you can see that, I assume, right? Okay, great. Thank you. Oops. There we go. So I wanted to start off with a brief summary of inflation, since that's top of mind for everybody. Here's a graph from 2020 till the most recent inflation data in March 2024. Inflation prior to 2020 and up until 2020 was generally very low, about 2% or even a little less. Then during 2021 and 2022, it shot up. It reached a peak in the middle of 2022, and then it's gradually been coming down since then. In this graph, I plot two different measures of inflation. There's the total CPI inflation rate, which basically measures as broad of an index of consumer purchases as the index can. And then in blue, a measure that many economists prefer, which is the core CPI inflation rate, the core consumer price index inflation rate. And that reports the average changes in prices, excluding the most volatile ones, which would be, for example, like gasoline, and a lot of fresh produce at the grocery stores, for instance. So by getting rid of the most volatile components, you get a series that's a little more stable over time. That's the blue line. And you get a better sense of the underlying trends that economists prefer to look at. So you can see inflation has been coming down in 2023 and 2024, but it's been coming down slowly. Okay, so the progress, the Fed is trying to get inflation back to 2%. So that's down here. And we're still a little ways from that, and we're approaching it fairly slowly. Okay. Now, we want to talk about what happened last year. Why was there no recession? And I think the best way to think about that is in terms of real interest rates. So economists talk about real interest rates, and it's just the interest rate that's effective after you adjust for inflation. So I've made a little table to help you see that. And let's look at the middle row of the table first. If the interest rate is 5%, which is roughly where short-term interest rates are right now, and the inflation rate is also 5%, then when you adjust for inflation, the real interest rate is effectively 0%, because the interest rate that you would be paying is effectively just keeping up with inflation, and there's nothing left over. So the net cost of financing after inflation would be essentially 0%. If you look at the top row of the table, there's another example, the same nominal interest rate, 5%. But now if inflation is 1%, the story is very different. Now there's a substantial cost of financing that's over and above the inflation rate. And in this case, the real interest rate, which is the difference between the nominal rate and the inflation rate, is about 4%. So there's a much more substantial cost of financing borrowing in that environment. And then finally, the bottom row of the table, I do one more example. Suppose the interest rate is 5% again, but now suppose the inflation rate is 9%, as it was in 2022. In that case, the interest rate that you're paying for financing would not even keep up with inflation at all. And so your cost of financing is even less than 0%. This is a great deal for borrowing, because the interest rate you're paying is not even as much as inflation is, right? The value of your loan is being eroded away more quickly than the interest you're paying on that loan. Okay, so that negative real interest rate when inflation is above the nominal interest rate is extremely stimulative. It's an extremely attractive time to borrow. Okay? So the real interest rate is what we teach our undergraduates matters most for businesses' investment decisions and for the economy. All right, the businesses can do this math. Most businesses can raise their prices at roughly the inflation rate on average. And if they can do that, then they know that they can increase their prices. If inflation is running high, they know they can increase their prices rapidly over the next year or two, and that offsets the cost of financing for business investment. So businesses will make this kind of calculation when they're making their investment decisions. Low real interest rates are very stimulative. Okay, so like we had in 2020, 2021, and 2022. So we talked about real interest rates. So now here's a graph of the nominal regular interest rate in orange for short-term loans. That's the federal funds rate that the Federal Reserve controls. And then in blue, I have the economist's preferred measure of inflation, which would be the core CPI inflation rate. And so this is a long history going way back to the 1950s, but you can focus on the more recent history. And the thing you should notice is that the cost of financing, the interest rate in orange, is typically above the inflation rate in blue. Okay? It's only very, very recently here in the 2010s, since about 2009, that those orange and blue lines have reversed. And in fact, you had the cost of financing, the federal funds rate below the inflation rate. Okay, so that's very unusual and also very, very stimulative, right? The interest rate is not even keeping up with inflation. It's an extremely attractive time to borrow and to finance. And it's generally historically extremely, extremely unusual. More recently, the Fed has raised interest rates substantially. That's the orange line at the very end. And the interest rate has now come up above inflation, the blue line. And now the relationship between interest rates and inflation is much more normal. Okay, so now the interest rate is above inflation and only moderately above, so not a lot above. So even though the Fed raised interest rates a lot in 2022, it was from an extremely accommodative, stimulative level to a more normal level. And so that's why, if you want to understand what happened in 2023, it's really that. Even though the Fed raised interest rates a lot, they never raised them substantially higher than inflation, only a little higher than inflation. And so the economy really sort of was able to carry right along with that. So in answer to the first question, what happened? The Fed raised interest rates rapidly in 2022 and 2023, but that real interest rate never got very high. The economy has been strong. It did not slow down very much because the real interest rate just never got so high as to really deter much business investment. Going forward, what's next? Real interest rates are somewhat positive now. It's kind of normal from a historical perspective. It's a little bit restrictive. It's not as attractive to borrow as it used to be. That should slow the economy down gradually, and inflation should continue to fall gradually, because if the economy is slower, businesses have a harder time raising prices when their demand is a little bit on the weaker side. Okay, so inflation should continue to fall, but gradually. The final slide I have for you is just a forecast from the Federal Reserve Bank of San Francisco. This is from last Thursday. It's a publication the San Francisco Fed puts out called Fed Views. It's their assessment of the main trends in the economy. In the left panel, I have their projection for real GDP growth. And in the right panel, I have their projection for inflation. And their forecast is essentially what I just said. The economy is currently doing pretty well. That's over here with GDP being a little bit above the trend line in green. And they predict that GDP will revert back to trend gradually. Inflation is higher than they would like. That's over here on the right. And they predict it will continue to decline back toward that trend green line of 2%, which they're aiming for. Okay, so that concludes my prepared remarks. And I'll turn it over to the next presenter.
Thank you, Eric. Professor Branch, would you like to go next, please?
Yes. Let me pull up my slides. You can see those okay? Okay, all right. Well, good afternoon, everybody. I'm going to piggyback on Eric a little bit and concentrate my remarks on lessons that were learned from two of the most sort of impactful periods of difficult economic times. So the high inflation in the 1970s, and then that low inflation period right before 2020 that Eric was talking about quite a bit in his remarks. So the 1970s were a period when the US and many of the other industrialized countries had really quite high rates of inflation. Economists sometimes refer to that period as the Great Inflation. And among the policy lessons that central bankers and economists learned was that central banks really needed to be aggressive early on in responding to inflation and raising interest rates before inflation sets hold too much. And the realization for that is about the role that inflation expectations play in the economy. So inflation expectations are about what people and firms think is going to happen to inflation between now and some point in the future. And so Eric described the real interest rate as being the difference between nominal interest rates and inflation. For many of the kind of economic decisions that people care about, it's really the difference between the nominal interest rate and what they think inflation is going to be that matters for decisions. So if workers are expecting high inflation over the next year or two, then they're going to want cost of living adjustments and their raises. They might accelerate some consumption purchases that they're making now. And so as they're speeding up their economic activity, then inflation also might rise today. So in this picture here, I'm showing you a historical relationship since the 1970s between CPI inflation. So this is consumer price inflation is on the vertical axis there. And then on the horizontal axis is a survey measure of inflation expectations. The University of Michigan has been surveying consumers for many decades, and they ask them lots of questions about what they think is going to happen to the economy. And among the questions they ask is, what do you think will happen to prices over the next 12 months? And so this relationship then is giving that measure of how inflation expectations about the future are impacting inflation rates today. And the blue line there is giving that statistical relationship. So we see a fairly strong and positive relationship. And so if we were to use econometric analysis, we could even make a stronger statement that if inflation expectations were suddenly to jump up, then we would expect to see a similar jump in inflation, but not quite as strong, about 60% of what happens to inflation expectations. And so here I've highlighted in green what is how inflation expectations and inflation unfolded starting from COVID until after. So you can barely see it, but just about right on the line there is February of 2020, so right before COVID. And so we were right about on the trend line in the relationship between inflation expectations and inflation. And then what we have is as the inflation that we saw in the US started to become much higher, then we saw inflation expectations becoming higher as well. And that was a bit short-lived with the Fed's response, and inflation expectations then declined pretty suddenly going into 2023 and continuing on until today. So just tracking the inflation expectations over this period, then we saw that going into the second half of 2021 and into 2022, a large spike in inflation expectations. And while they've remained pretty volatile, they've come down quite a bit ever since then. And so to me, that's a bit of the explanation for why it is that we haven't seen the inflation continue and that we've seen the disinflation, is that we've managed to anchor private sector expectations. And that was one of the lessons for the 1970s, was that if you don't get ahead of the expectations and the central bank aggressively act to bring inflation down, then there can be feedback effects that operate through expectations. So the private sector starts to see that there's been some inflation, they raise their inflation expectations, then they take their decisions, make their actions, inflation becomes higher, then they raise up their inflation expectations, and you get this price expectation spiral. And the fact that the central bank did act so aggressively in 2022 helps explain why expectations stayed anchored and inflation came down. Now, one of the other lessons that the Federal Reserve took away after the great financial crisis in 2007 and 2009 was that really long period of low interest rates and low inflation. So here I've plotted in the top graph that same federal funds target rate that Eric showed us, but zeroing in just on the period starting with the Great Recession. And we see that they kept interest rates at zero all the way up until 2016, started to return to a policy of normalization, COVID hits, and then they drop their target rate back to zero. Then when the 2021 inflation, really into 2022, they were very aggressive in raising interest rates. If you just compare how steeply they raised rates in this most recent episode compared to right before COVID, you can see how much more aggressive they were. And part of it was they had this long experience of going after the Great Recession with inflation running below their target for most of this period. And so one of the lessons that they were drawing was trying to think about, well, is having a 2% inflation target, which is what their target rate is that providing sufficient insurance against a future recession? So sitting in this period with low inflation and zero interest rates, what if the next shock comes along? Was there sort of sufficient room to lower interest rates to deal with things like the COVID pandemic? So going into 2020, the Fed launched a pretty extensive review of their policy process. They talked to the community quite a bit. And one of the questions that they were addressing was, is 2% the right inflation target? And so there was some thought that maybe 3 to 4% inflation target provided a greater insurance against these bigger shocks. But the economic evidence about whether a 3 or 4% inflation target was not so persuasive. And so that part didn't really enter into the Fed's policy review after 2020. The other aspect that they sort of were realizing coming into this was that one of the old jokes about the Fed is they take the punch bowl away right when the party starts to get fun. So one of the realizations was from the Fed is that maybe they should let marginalized communities come to the party also. And so if economic gains were really hitting some of these communities sort of late into the business cycle, then the Fed should really be somewhat careful about when they start to normalize interest rates. And so the result of that was that the central bank remained committed to an overall 2% inflation goal, but they opted something that the economists call average inflation targeting. So it's 2% is the goal, but averaged over some period of time. And so by averaging over some period of time, you can allow inflation to go above that 2%. Eventually, you sort of want to bring it back. I put committed into quotes because, well, it's not really obvious what they're committing to here. So while the Federal Reserve has said that we want 2% on average, they haven't really been very clear about over how many years that they're averaging. And so being sort of vague about what exactly that goal is, they can say they're committed to a 2% goal, but allow themselves to be effectively more dovish. And so my sort of read on the stance is that the Fed's not too unhappy with 3% inflation as long as unemployment is low. And so we're sort of seeing that slow transition towards 2%, and the Fed's more or less happy with that. So long as inflation expectations remain sort of bounded and anchored and not leading to what might be a feedback effect. But with higher average inflation is going to be more volatile from month to month. And so we saw that in some of the most recent inflation readings there was a bit of a jump up and people panicked a little bit. Did that mean that the trend of disinflation is reversing? And it may or may not, but we have to sort of get used to that we're going to be in this world of a bit more inflation volatility until the disinflation arrives at 2%. And so the Fed is going to be carefully tracking what's happening with expectations. And so my sort of view is exactly like Eric's, but with a bit more upside risk to interest rates going forward.
Bill, super interesting. We're going to get into this sort of 3% to 4% kind of number a little bit more when we get into our next discussion, but very helpful to frame it that way. Thanks very much. Jessica, we'll let you go next. Thanks.
Hi, everyone. Thank you so much to the UCI School of Social Sciences for including me in today's event. So I'm Jessica Monge Coria. I'm a Senior Regional Manager in Community Development at the San Francisco Fed, and I'm going to start with my disclaimer The views that I'm expressing today are those of the author myself, and not necessarily those of the Federal Reserve Bank of San Francisco or the Federal Reserve System. And unlike my fellow panelists, I'm not going to be showing any charts today, but I am going to talk a lot about what we're hearing on the ground in the economy, in the communities that I work in. So first, let me give you a little bit of a background about why community development exists in the San Francisco Fed. So we're committed to and dedicated to building an economy that works for everyone, especially all Americans having the opportunity to truly fully realize their potential. And that's regardless of gender, race or ethnicity, their geography, their ability, their socioeconomic status. And we pursue our two key goals of maximum employment and price stability, which we all know as the Fed's dual mandate. We want to work to ensure that our economy and every American is able to reach their full potential. So in community development, we are focused specifically on low-income communities and looking to address barriers to economic participation within those communities. And how we do that is through three key methods. We conduct research, we build partnerships, and we engage directly with communities. And I myself am responsible for conducting outreach throughout California. For my region, I am working from basically Kern County, San Bernardino, all the way down to San Diego and Imperial counties. And as of the last census, that means 24 million people almost call this region home. So beginning in early 2022, we began conducting listening sessions in communities across the region, asking them how they were dealing with price increases and what is their experience with the local labor market. And we often talk about the Fed as being heavily data dependent, right? We have a lot of charts and we have a lot of quantitative data. And this data allows us to identify trends and make informed decisions, but we also understand that they only tell a part of the story. So the main purpose of my role is to learn about how people are experiencing the economy in real time. So pretty recently, Federal Reserve banks across the country have been collecting anecdotes and concerns from contacts for Federal Reserve beige book summaries. And those are published 8 times a year. And historically, this is a change. So before, the insights about conditions affecting low and moderate income communities have traditionally come from the perspective of businesses. But in the fall of 2022, several reserve banks, including the San Francisco Fed, began including a community conditions or community perspective section, which helped provide insight into local changes through direct accounts of nonprofit and community leaders, as well as workforce professionals serving lower income people. So just to really quickly to have some takeaways from the most recent beige book, this was prepared based on the information collected before April 8th. And this is summarizing some comments that we received, again, from contacts outside the Federal Reserve and not a commentary on the views of the Federal Reserve officials. But what we heard was that demand for community support and services has remained high. So limited funding and strained resources is the new normal for many nonprofit organizations. Households and community members continue to seek assistance as they face challenges with the cost of housing, utilities, food, health services. Some contacts report that as government funding has been partially compensating for the decline in financial support from the private sector and grants, as well as individual donors. And that can be often difficult as public sector funding tends to be more restrictive in uses. So to address specific issues such as housing security, and that limits the nonprofit organization's ability to address other issues facing community members. And then we also heard that small businesses across the 12th district, of which the Federal Reserve Bank of San Francisco represents, continues to face high borrowing costs, which limits their access to funding and loans. So this district information is really reflective of what I have been hearing locally for the past 2 years, that inflation pressures haven't eased much in Southern California, and that communities are still struggling with the price of necessities, so particularly food, energy, and housing, and that the increases to continue to outpace wages. And that persistent pressure of high prices has exacerbated those day-to-day difficulties for many families. Another common theme across the listening sessions is housing affordability as a top concern, and it affects communities across all income levels. And our region in Southern California has the most acute need for affordable housing in the state and probably maybe even the country. So for example, in Orange County, renters need to earn approximately $51 per hour or 3.3 times the state minimum wage to afford the average monthly asking rent of $2,762. So this is according to California Housing Partnership's most recent affordable housing needs report. And even in nearby Inland Empire, which we always consider to be more affordable, renters need to earn 2.3 times the state minimum wage, or approximately $36 for an hour. So these housing costs has also created additional barriers to employment. As lower income individuals move farther away from their places of employment, the cost of gas to get to work might not be offset by wages offered. And then the question then becomes, with prices remaining high, where are all the potential employees? As we know, hiring challenges remain plentiful, both in recruitment and retention. And there's a strong preference of workers for remote work because of the flexibility afforded to those workers. And on-site jobs, including retail, hospitality, tourism, caregiving, they're unable to meet those requests of potential employees. And despite increased wages, are having difficulty with recruitment and retention. So one hypothesis we heard a lot was that many workers have left the labor market and began their own small business. So before the pandemic, roughly 3.5 million Americans started businesses each year. And after the pandemic, this figure jumped 54% to 5.4 million in 2021. And on the slide here, I just wanted to let you know that for a lot of our research, we put it all on this one website called fedcommunities.org, which brings together all the Federal Reserve Bank's Community Development Department's various research that's happening. And one of the recent things we put together was our Small Business Credit Survey. It's a national online survey administered annually through a collaboration of all 12 reserve banks. And this is some of the data we saw. So they're continuing to see challenges in hiring and retaining qualified staff. And we're also seeing a difficulty in potentially growing sales. So over half of these businesses saw a difficulty in growing sales and reaching customers. So what does that mean when we talk to all these, nearly 11,000 small businesses across the country responded? Those themes are that high interest rates remain a challenge. The financial health of small businesses is declining as a result of the post-pandemic boom. They remain difficult to hire and retain workers. They're trying to utilize technology when available to address their staffing issues. And there is continued interest in startups, but there's very little capital that's affordable and patient enough to help support those startup businesses. And there remains a higher demand for service-oriented businesses versus retail. The other research I really wanted to highlight was the Worker Voices Project. This was something that we took on in 2022 and published last year. So this provides a unique view into how job seekers and workers in lower wage roles navigated the labor market at the onset of the COVID-19 pandemic and through the recovery, and how it changed what they expected from a job. And these participants were primarily, everyone did not have a bachelor's degree, high representation of unemployed individuals, women, people of color, and individuals in low-wage roles. And we learned a lot, especially about what a quality job includes, being adequately compensated, treated well, feeling secure in their position, having flexibility around hours and location, feeling engaged with their work. and why self-employment also was often seen as aspirational or a way out of the traditional labor market. We saw both a push in terms of a dissatisfaction in their current workplace or options, as well as discrimination and systemic barriers to employment, but also a pull, being able to enhance their own potential, feeling greater agency and independence in their work. And these qualitative data from workers raise important questions around the future of self-employment and whether or not we see this increase as a structural change in our economy or just more of a cyclical change. And also for us to think through what do these activities mean for the changing nature of work and labor market. And I think it really opens up a new avenue in terms of how we see the economy performing beyond just the unemployment rate. So I'll stop there.
That is great, Jessica. Thank you so much. And thank you for highlighting that part of the economy. I think we read a lot about or watch on television a lot about some more macro issues in the economy or large corporations that are driving bigger part of the economy. We don't hear as much about what you were just speaking about, and it's really very helpful to hear all of that. Let me just continue a little bit on what you were talking about, if I may, and just open up our questions to our panels. But I'm curious, Jessica, is there a sort of an equilibrium? If the inflation is a little too high right now, if interest rates are a little too high, and that's causing some detriment to that part of the economy you're talking about, is there a point that we should be driving towards that would achieve a balance? Lower interest rates are better, but because we're also seeing, the employment numbers are still pretty high. 303,000, I think, in March. I think a lot of people were thinking, gosh, it's not going to be that high, and here it was, high again, and unemployment is low. So how do we balance these things? How do we think about that relative to the groups of folks you were just referring to?
I think a couple of things that I think is important for us to remember is that, we had never really experienced a global pandemic like we did. And so the result of how we bounced back just was not what people understood to be a reality. And we keep reaching these different levels of saying, oh, well, once all the surplus or once all the PPP runs out or all the government assistance, then we'll really see people, really start to return to the workforce. And I think we see some of that maybe with the increased job numbers that we're seeing recently. But what we've also heard is just people's viewpoint on how they see work and how they want to be able to generate income has changed dramatically. So if you're just trying to meet the bare minimum of your needs, and that was being met potentially with, a lower wage job, your ability to maybe generate that same level of income, being either self-employed or starting a very small micro business, that might actually work out. Even if you're working more hours and you're dedicating more of your time to that job, to that business, you're able to then feel a greater sense of, self in potential. You're able to work around your own hours in terms of flexibility. So I think that there's just been this change in how workers see the labor market, but also the economy and how they want to generate income for themselves. And I do think that there's this weird tension now between wanting interest rates to come down, but then not wanting to lose any of that in the employment market in terms of low unemployment.
Right. And Eric, to your charts and thinking about real inflation and interest rates, and we're sort of entering this new period right now. Is this predictable. So maybe timing is everything here, right? We just missed it. We thought last year was going to see a downturn in the economy, and a lot of people predicted that, and we were off on that. But look, we're coming out of COVID, and we're coming out of huge economic stimulus into the economy and some things like that really threw some big monkey wrenches into cash available and so forth. Are we entering a more normalized time? Some of the graphs you presented showed it looks like we're going to hit a soft landing here. It looks like it's going to level off, and we're approaching those 2% numbers that you talked about. Can we predict that? Does that feel like where we're going?
So I would say basically, yes, this is more of a return to normalcy. It's been abnormal for many, many years. I mean, COVID was very abnormal. And then even before that, as Bill was pointing out, and as you could see in the circle in my diagram, it was a very abnormal period for interest rates before. So, I mean, will interest rates go back as low as they were before? Almost certainly not. I mean, this is a little bit more of a more normal period. Inflation should decline some, interest rates should decline some, but they're not going back to 0% short-term interest rates in anytime soon, right?
Yep. And Bill, so you were talking about expectations and making sure the market is or thinking about how the market is expecting certain things, and I think everyone's been kind of holding their breath a little bit about interest rates, among other things. I mean, interest rates are one measure, but in thinking about housing and some sectors of the economy, home sellers have been holding off, home buyers have been holding off. There's probably a lot of pent-up demand here for a trade in housing. And you sort of explored this idea of whether 3-4%, I mean, March was 4%, whether these are bad numbers. I mean, is the economy bad right now? We hear some news about consumer sentiment being mixed. Some people feel pretty down on it. Others feel pretty up about it. And yet we don't really see a crash heading our way. I mean, I read the papers every day. I'm looking at CNBC. I don't see a big crash headed our way. Is this so bad right now? And also with the backdrop of we've got a lot of corporations reporting earnings this week. I think famously everyone's looking to see what Tesla is going to do this afternoon. Are we in a bad time, or are things really okay?
I was pretty looking forward to Jessica's remarks also, because I'm also sometimes puzzled, at least the political narrative, how it gets spun with the election coming, about people being unhappy. Yeah, I mean, if you just look 3% inflation or so, it's not so bad. Unemployment is certainly stable, and seems like things are going fine. I think a lot of it is just sort of how people are receiving the current economic conditions that can sort of cause people to maybe perceive it to be worse than it is. So, I mean, one of the things that really drove the early stages of this inflation were grocery prices. And so if it's like that's the price that you as a consumer are seeing most often, then you're really living the impact of that inflation in a way that's totally transparent to your day-to-day life. And then I think it's the same thing with the higher interest rates. It does seem that it has made areas like where we are in Southern California even less affordable for homes than it was. And we have lots of young professors in the economics department here, and they're all trying to wade into as first-time home buyers into the Southern California market, and there's just not a lot of supply, and so it's tough. So I think a lot of that is people feeling just the relative prices more so than the average inflation prices. And then the 3 to 4%, I think that was a lot of what drove the people who were advocating for it in the 2010s was what's really different between 2% inflation and 3%. So if we think inflation's costly because it's costly to change prices and it's distorting people's decisions. And then really 2%, 3% is not such a big deal. And so we should maybe just tolerate 3% or even 4%. And then the federal funds average rate will be higher. That'll give them a bit more room. But the flip side of that is that when inflation rates are higher, they also tend to bounce around a lot more. And it does raise that risk of unanchoring people's expectations and launching these kinds of wage price spiral feedback effects that the Fed was really, experienced during the 1970s and continues to have a hangover effect from. And so I think most of the research that was done in those 2010s was not really supportive of a 3 to 4% target. Which is why I think the Fed sort of landed at this, well, we'll do 2%, but we'll be more tolerating of deviations from that.
Yeah. And for everybody, but Jessica, partially on your comments as well, if wages aren't keeping pace with the rest of the economy, particularly in certain sectors, but I mean, I've got kids who are entering the economy. They've got jobs. Their wages are not terribly big yet necessarily, and they want, they're thinking about home ownership one day, or you've got a lot of young people who have student debt and things like that. And we live in Southern California here. Housing has gotten to be pretty outrageous. It's hard to imagine that home ownership is going to be within reach for a long time. And as you said, people are moving out further, right? Because they can, and technology and COVID sort of allowed for this, but it looks pretty challenging for a long time here, I would imagine.
I mean, housing makes up the largest portion of anyone's household budget, right? And I don't think that we anticipate, at least in our region, those prices going down at all, right? So at most, we could hope for a stabling effect of no more increases. But I mean, with such little production and with such high occupancy, and I mean, despite the news of people all leaving Southern California, we still are a place of people want to reside in for multiple reasons. Our weather not being one of them, but I mean, one of the main ones, but other reasons as well. And I think because that makes up such a huge portion of anyone's budget and that not coming down, I don't know that people will feel the effects as acutely because they won't see their total amount of budget really increase, especially or return to the pre-pandemic levels, basically. And when we heard is housing is first, and then if you are a parent or you're part of the sandwich generation, you're dealing with caregiving on both ends, either with your own children or maybe with your parents. So that's a big push potentially out of the labor force if you're not able to recover enough wages to take care of those caregiving needs. And then utilities and food and health services, all things that we don't see decreasing necessarily in terms of their cost in the future, I think. So I think that's like some of the things about what Bill was saying about how we aren't feeling it because we're still feeling like negative because a lot of the things that the average consumer person thinks about in their household budget has changed significantly and isn't going to go back to where it was before.
Right. And I saw in the latest numbers that the cost of automotive is going up. So you got housing and automotive prices increasing. Just one more quick question here, and I'll hand it back to Dean Maurer. Eric, I know you've done a lot of work looking at these trends and spending time at the Federal Reserve. What should we as consumers be looking at and thinking about in the coming year here, a couple of years, as things kind of calm down? Are there particular metrics that we're looking for, and what are we keeping an eye on?
Are you interested in inflation trends or more like output and employment trends?
I think, a balance of a little bit of everything. I think, interest rates hits the top of the news a lot, but
Yeah.
but really, kind of everything.
So, I mean, the Fed and economists look at all the major statistics. We'll have a GDP number coming out next week. You get employment numbers every month. You get inflation numbers every month. So, I mean, you see those every month. You try to, any one of them is pretty volatile in isolation. So you should not focus exclusively on any one indicator. You just want to look at sort of all of them and try to get the whole picture. And you don't want to look at any one month in isolation. It's actually, earlier in the year, a couple of the inflation numbers came in very good, very low. And that got the market very excited that maybe inflation would come down faster than people had thought previously. And those turned out to be a little bit anomalous, that actually, after 2 or 3 good numbers, then we got 2 or 3 worse numbers in a row. And so if you average through the high frequency fluctuations, you'll see more of the trend. And the trend has been slow. It has not been a rapid decrease. So you have to keep all of that in mind. Look at a broad array of data and don't look at any one month. You have to look at several months in a row to figure out where the trends are going.
That's great. Thank you so much. To the whole panel, thank you guys so much. This has been fascinating. We could easily keep going here. We want to allow a little bit of time for our audience to ask some questions. So, Dean Maurer, I'm going to hand it back to you and let you have you facilitate that for us.
Great, thanks, Peter, and thanks everyone. This has just been so interesting. There's one question that popped in that Jessica just answered, but I'd love to just pose the question to the group, and maybe Jessica, you can put the link in the main chat so everybody can see it as well. And this is from Kazuto, who says there seems to be plenty of acknowledgement of the gap between economic conditions on paper versus on the street, but not a lot of discussion around why and how to bridge those gaps. And Jessica included the link to the Beige Book Community Perspectives thing, which we'll put in the chat here as well. But I wonder, for any one of the panelists, how you might address that question.
I'll start. It's a hard question to address because we don't know exactly what everybody's feeling, and it's sort of a very fuzzy concept. I think personally, I think a lot of what people feel, which Bill Branch alluded to, is I think some of the lagged effects of inflation. Like, yes, inflation is coming down, which means prices are not going up as quickly as they used to be, but we've still had a lot of price rises, and it's not like prices are coming back down. Prices are still, they went up and they're staying high, and they're even continuing to increase a little bit more. And that's what hurts people the most, right? The cost out of pocket, and those costs have not been coming back down. So I think there's a little bit of a language issue. When economists say inflation is getting better, it means the prices are no longer going up as much as they used to, but they're still very high. And I think that's what people feel, is just the high prices.
Bill, I might suggest that another panel you might do is how people get their news. So part of it is that the Federal Reserve policymakers, they work pretty hard to try and communicate the message. And you can see Jessica's office obviously does a great job for the San Francisco Fed. But how people are consuming that information that's put out, maybe that's changed, and it's not so obvious that they're there should be headlines that egg prices are back to normal, right? We had all the headlines about high egg prices.
Yeah, that's true. Everyone wants to talk about the bad news, but maybe not necessarily the good news. I think that there really has been a huge shift in the way the Federal Reserve really wants to hear from community. I mean, we do Fed Listens event. I dropped that in the chat, and we try to get super nuanced. Like, how did this affect youth specifically? Exactly what Peter was saying. People that are just graduating from high school or college. What does this labor economy mean for them? How can we start to address their issues? Because we're very not aware that it is a completely different world and economy than we remember from 2020. And we have to constantly remind ourselves that post-pandemic isn't pre-pandemic just 4 years later or whatever it is. It's a completely different way of thinking about our economy, the labor market, and how we interact with it.
You know, this is a related question, but and I'd love to get this one in before we have to break. And this comes from Luis Alberto, who says, are there any outlier variables that people are keeping an eye on that might drastically change the current trend? And then the sub question is, what about our current political climate?
Yeah, we've tried to stay away from politics in this conversation today, but we're in a presidential election year, and but yeah, I'm curious. Are there external or indicators on the fray here that we should be looking at?
I think for us, we're very keen to hear what workforce development professionals are hearing. If people stop trying to go to their training and upskill, or they're not taking advantage of things that are being offered from the community college level perspective, that's that makes us nervous, right? You know, we saw a big decrease in the number of people enrolling in community colleges because this is our workforce that's kind of just either trying to transition from a current job or maybe look to gaining some new skills so that they can grow in their own career. And when we see that not happening on a regular basis, that can be scary. But we saw that's turning around, you know, as people are able to kind of get back under their feet. They're starting to really flood those trade and technical colleges, classes, you know, again, and are looking to do that type of work.
So I'll say from 8 years ago, I guess, being asked questions like this and also trying to avoid any political answers, I said elections often introduce uncertainty, and uncertainty brings about caution in economic decisions, and ends of elections remove that uncertainty and generally tend to be pretty good. This year is a little unusual in that we have two former presidents that are, or one current president, one former president running against each other. So the uncertainty about their administrations, I think, is lower than typical elections.
I mean, I'll just mention you never know what will cause the next recession, but I mean, you always sort of think about what are the possible shocks that could happen. One is real estate markets, like they're talking, you know, with the increasing work from home, there's a lot less demand for office real estate. And so actually there's a lot of bank lending to commercial developers, which are probably underwater loans. And so you worry that, you know, if there's widespread defaults on those loans, it creates a banking crisis. We saw a little bit of that at the beginning of last year with some of the Silicon Valley Bank and Signature Bank and the others. Those weren't tied to commercial real estate, but you had a miniature banking crisis, and you could see a bigger one. That's a risk. Another risk, if China was to invade Taiwan, you know, that's probably years away. But if they did, that would cause a recession for sure, I think. And so you never know when something like that is going to happen. If Russia dropped a nuke on Ukraine, right, that could create huge repercussions in the financial market. That might tip things over. So you never know.
Let's hope some of those don't come to.
I was just going to say.
Thanks,
Eric.
Always. But on the commercial space, you know, office buildings, and there's a lot of debt coming due that hasn't come due yet, with some very big numbers attached to it. And yeah, you got debt holders who don't want to take the keys to those buildings, and there certainly will be an economic impact to that. I would imagine, at least in that sector of the economy, anyway.
Yeah, which may also be another great topic for a future forum.
We've got so much to discussion in future forums for sure. We didn't get into economic modeling today. How do you model all this stuff and not let your models blow up every once in a while? There's a lot to talk about in the future.
Yeah, and there's other great questions here that we're just not going to have time for, as it's 1 p.m. already, on age discrimination in the labor market and income inequality and all kinds of things we could sink our teeth into. But it is 1 o'clock. Let me thank our panelists, Eric, Bill, and Jessica. Thank you so much for sharing your insight and expertise with us. Peter, thank you again for hosting and moderating. And also a big note of thanks to Andy Hill and Melissa Trelawney in the background for keeping the Zoom running and making everything so seamless. Thank you to those of you who joined us today. We do these, a couple times a year, so you'll be hearing about the next one in due course. And I hope everyone has a terrific afternoon.
Thank you all.